Okay, we're going to take a quick look at the gold chart, long range, and also look at a pattern that developed over a pretty long period of time that has some implications for what I would call an intermediate uh, price target in gold. This is freechartvideos.com, using time-honored techniques to understand modern markets. And let me put this in a nutshell. I'm not a licensed professional. I'm just a guy who draws lines on charts. You have to make your own decisions about what to do with your money. So let's look at the gold chart. Okay, I'm using the gold ETF, GLD, as my proxy for gold. And there are a couple things to point out. First off, when prices were down, the value of gold, you just got to add roughly add a zero over here, around 600 an ounce. There was this kind of a little consolidation pattern. Gold had gotten as high as 720, then bounced around for about a year and a half, broke out of this pattern, ran up to the top here, tagged 1,000, made one little dip, made a bigger dip, made a smaller dip. By the way, this also was two little dips and two little dips. And what do we call this pattern right here? One dip, larger dip, and a smaller dip. It's an inverse head and shoulders. These usually appear at bottoms, or the non-inverted type would appear at a top. But there are times when this pattern will show up as a consolidation. This pattern has shown up in the S&P just recently over about a 5-month period as a consolidation head and shoulders that is broken out and is driving the markets higher. A lot of the bears have missed this. They didn't see that pattern. They're looking for something else. They're missing the obvious. So how do you figure out what your price objective is from gold? Well, from any inverted head and shoulders, you get the distance from the neckline, which is drawn from the recovery of the first dip to the rally point of the large one that comes out of the large one. You measure that distance, and then you add it on to where it broke out. And in this case, we get a price of about 1,410 or 141 in GLD. Now, I want you to also see that gold is working in a channel. Now, albeit we only have 1-2 touches on the bottom and 1-2 on the top, but if you look at this implied distance here, you can see that reaching that 141 or over 1,400 an ounce doesn't even have to reach this top trend line for that to happen. Additionally, we have another trend line that goes from this peak to this peak that also defines a smaller channel that is actually more aggressive than the overall channel. And what I'm saying is, this being the minimum, about 1,400 an ounce, you know, I've heard a lot of analysts say they think 1,650. That could very well be. So I'd be careful here if you're short, and I'd be patient here if you're long. If you have no position, then buy on weakness, and just watch those stops, and be ready to move out of it if the market turns against you, because we are in between these major trend lines. I had bought GLD about here at 960. Back in 2009, seeing this as a developing inverted head and shoulders. The funny thing is that at the time I bought it, a lot of analysts were saying this was a double top. You know, you've got to look at the overall pattern. That's not the kind of a double top does not have this inverted head and shoulders does not have this shape very often. Double tops usually have a peak and another peak. This was a run-up, a correction, a larger correction in a scalloping pattern. That's not that just does not look like a double top to me. Anyway, good trading to you, and hope the markets treat you well. Take care. And of course, if you get the time, visit freechartvideos.com. We have videos that are updated on a daily basis. The S&P I follow every day with at least one, sometimes two chart video updates looking at what the action portends for the market. So visit often, and it's free.